Welcome to CNBC.com. I'm Frank Holland, anchor of Worldwide Exchange. We're taking a look at the ETF market. Year to date, ETF net inflows, they're topping $789 billion. Joining me now to discuss the ETF market and much more is Jon Maier, JPMorgan Chief ETF Strategist. Jon, thanks for joining us.
Thanks for having me, Frank.
All right, so first off, I want to start off with that. ETF net inflows topping $789 billion. We're on pace for another $1 trillion year. Just what's your general take of the ETF market in 2025?
You know, ETFs have become really the structure of choice. You talked about the inflows. We're on pace to exceed last year, which was about $1 trillion in assets. We're about $750 billion right now. What you're seeing right now is that because of the unique benefits of the ETF structure, liquidity, transparency, accessibility, you can access almost any different part of the market, combined with tax efficiency for most ETFs. Investors are seeing that they can trade ETFs on a daily basis throughout the day, and they're being attracted to that structure. It's the structure of choice over mutual funds from our perspective.
Well, it was quite a week this week. We saw some questions about a Fed governor possibly being fired, the Fed governor pushing back. We also had NVIDIA earnings. We're coming off Jackson Hole. According to Verify, that's one of the sources we use to track ETFs, the VGT, Vanguard Information Technology ETF, saw the top inflows this week. Is that surprising to you to see investors going into technology ahead of NVIDIA earnings?
Well, NVIDIA obviously is the bellwether in the AI space. And what you are seeing, many companies are continuing to spend. CapEx spending is very strong on the AI theme. So there's two parts to the AI theme. One, software and hardware companies that kind of support AI. And then those are the companies that are beneficiaries of AI that improves efficiencies, like utility companies, use of electricity, industrials. So AI is playing out through the entire ecosystem. And active management is a great way to utilize managing portfolios. JPMorgan is an active manager. We have hundreds of research analysts. We spend $1 billion on research analysts and technology, and we believe active management is the way to go. And when you're looking at some of these stocks that have very high multiples, you want an active manager because you want to find out, you want to put companies inside portfolios that are expected to do well going forward through research.
You mentioned that JPMorgan has one of the largest actively managed ETFs. What's that ticker, and what areas does that ETF have holdings in?
You know, the largest actively managed ETF that exists is JEPI. Some call it a JEPI, which is a derivative income fund. It's an option overlay fund. So that fund, JEPI, which is about $41 billion in assets, continues to see inflows, has two parts. It has a low volatility underlying portfolio that is similar to the S&P 500, but lower volatility. Then it also has an option overlay where we write 2 index options, 2% out of the money. So what investors receive is income on this portfolio with some upside, with some downside protection as well. So the volatility is lower than the S&P. It's about 60% of it. So that fund provides consistent income. There's another fund that we have is JEPQ, which is one of the largest actively managed ETFs as well, about $29 billion in assets, has seen significant flows. The underlying portfolio is benchmarked against the NASDAQ, also writes in 2% out of the money monthly index options, and provides income of approximately 11–12%.
All right, so those are two options for actively managed ETFs. What about an ETF to play the current market? Again, we're coming off NVIDIA earnings, NVIDIA moving lower post-earnings that were generally seen as good except for one weak spot. We also believe that we may be heading towards a Fed cutting cycle, but we get PCE tomorrow. That may be a major factor in that happening or not. Can you give us an ETF just to play the current market with the uncertainty and just some of the trends we're seeing in the market?
Well, I always think that diversification is very important in any portfolio. My DNA is managing portfolios at my previous employer. Now, that being said, you want equities as well as fixed income. We know that the Fed is likely going to cut in September. We also know that over the next 12 months, the forward markets are indicating that the Fed's going to cut between 100 and 125 basis points. There's about $7 trillion in money market funds right now. If rates are cut by 100 basis points, investors are going to be earning less on their cash. So they want to take a step out of cash into something that has a little bit longer duration, but still provides that 4+% yield or so. Some funds, intermediate core bond funds like J-Bond, JBND, which we've seen about a $2 billion inflow this year. It's an investment grade portfolio, JBND. That's one idea, that investors can maintain their current income when rates are cut. If you want to go a little shorter, that's not quite out of money market. Another that's largely an investment grade portfolio is JPST, another way to diversify your portfolio from equities to fixed income.
All right. Is there one of those you see as the best way to play this current market, and if so, why?
Well, if you are looking on the equity side, and we believe that active management makes a lot of sense because you are doing bottoms-up research. You're looking at those individual names in the portfolio that, is XYZ company overvalued or undervalued? An active manager can make that decision. JGRO, JGRO, which is large cap growth, which we believe is a good way to play the current environment when there's just a few names that are driving performance.
Jon Maier, really great to have you. Thank you very much for your time and for your insight. Jon Maier, Chief ETF Strategist of JPMorgan, thank you for being here, and thank all of you for watching CNBC.com. I'm Frank Holland, anchor Worldwide Exchange. Have a great day.
Thank you.